Well, good afternoon, everyone, and it's a great pleasure to be able to present our views on the global equity markets and focusing on Asia, and then ultimately giving our views on India as well. I will take about 25-30 minutes to go quickly through the presentation we have, and then I will welcome the Q&A that we'll have and the conversation afterward. So without further ado, let me go, first of all, just give us a quick snapshot of what we're thinking about global asset markets. And the key points here are that we continue to prefer equities among the various global asset classes. We're optimistic there, although expecting moderate levels of returns for reasons I will articulate in a moment. We're very positive on commodities. We've had a very strong view about commodities being in a super cycle, and I think we are well above consensus there. We also, somewhat interestingly, are overweight cash for the time being, given the complexities of the global investment environment and some of the risks therein. Our chief funding area would be in government bonds, because with the change in the monetary cycle, we think that bonds which have been giving negative returns this year will continue to be under pressure. So certainly for the developed market complex where rates are rising, we think that bonds are not a good place to be, and so they are our principal funding area. And they were also underweight credit, thinking that credit spreads are tight and probably need to widen out somewhat, and we don't see particularly attractive returns there. So the bottom line here is overweight equities and commodities, and underweight generally most aspects of fixed income. In terms of returns, a lot of numbers on the page, but the real key to focus on is that we're looking for sort of moderate, kind of low teens upside to our various benchmarks. We're a bit more optimistic on Asia, but the broad complexion of things is that we're looking for an environment where we have moderate, sort of high single-digit earnings growth, in some cases some valuation recovery, a little bit more pressure on the United States, which I'll get into a little bit later, but that's broadly the configuration of our views for the global equity market class. Drilling into this a bit more, this chart shows the valuations for the key regions globally, the US on the left, then developed Europe, Japan, and then Asia ex-Japan. I think the key point from this chart is that the US does stand out as being more richly valued in both absolute and in terms and relative to its range, whereas the other areas, particularly Europe and Japan, are at the low end of their respective ranges. So broadly speaking, you look at sort of 18 times forward earnings for the US and sort of 12 to 13 times for the other markets. And that is one of the underpinnings for our view currently to be tilted somewhat away from the United States. Not that we're bearish on the US, just with the recovery we've had, we don't have that much upside to David Costa and my US strategy colleagues' target of 4,700 for the S&P 500. Now, if I could step back a little bit before going into the topical issues of the day, I want to highlight for everyone a broader view here, which I think is quite helpful, because oftentimes we get lost in the day-to-day minutia or the high-frequency news flow, and it's very important as investors for us to step back and look at the bigger picture. So this is from my global strategy colleague, Peter Oppenheimer, and what we note here is that really over the past century, there have been three very long, what we call super cycles since the Second World War, which have been, of course, very favorable for overall investors. And those have been punctuated by what we call fat and flat environments, which are basically where you've got a wide trading range, where on balance, the market doesn't make that much progress, but there's a lot of volatility. We think we're entering one of those now. I'll go into a little bit more of that and what you do with that in a moment. So it is a somewhat more challenging investment environment, but there still is plenty of opportunity in there. You just have to approach it in a slightly different manner. Now, part of the reason why we think we're transiting into this fat and flat environment is that interest rate cycle is turning. And this is a very interesting chart for the Bank of England, which goes back 700 years. I would challenge you to find charts that go farther back in time than this. But going back literally to 1300 in England, we can see what interest rates were. And as you can tell from this, obviously there's been lots of sort of spikes and troughs, but the overall trend has been to lower interest rates. And of course, most recently with quantitative easing, we've had interest rates being close to zero. So we think that is changing now, and particularly if you zoom into the right side of the chart, we can see that this very powerful, nearly 30-year bull market, which started in the early 1980s, we think that's ending and that we're going into a period of higher rates. We don't think they're going up as much as we have seen on this chart, but certainly interest rates are going to be a different environment than the one that we've been enjoying for the past 30 years. And we need to take account of that in terms of our investment views. Now, zooming a little bit more into the current issues, of course, inflation is a growing, clear and present danger. I'll talk more about that in a moment, but clearly inflation is a concern for equity market participants, particularly because we've had this spike in commodity prices. And what we note here is that typically higher inflation tends to put pressure on corporate profit margins, which is something that should be of concern to investors. And this is one of the things which has been promoting a shift from the leadership of the growth style in the market to more of a value style. I mean, growth, when rates are low, growth tends to be favored because growth is what's technically called a long duration asset. It's where people look out into the future and anticipate all the potential growth that could take place. And since interest rates are low, they value that future growth more highly. When rates start to rise, then growth tends to come under pressure, and the value part of the market tends to do a bit better. This is something we've been writing about for about a year. I think there still is further to go in that. But that being said, we would note that the technology stock fundamentals are actually still quite strong. So we think it would be incorrect to be getting significantly bearish on technology, simply because, as this chart shows, the profitability and the earnings of the tech companies have significantly outstripped those of the rest of the world. Here on this chart, for those who can't see it, this is the darker blue line is the overall profitability of the global tech complex, and that's significantly outstripped that of the other parts of the market. And if we drill further into this and we look at the valuation of tech at previous peaks of the tech cycle, which goes back to the tech bubble in the United States in the late 1990s, and earlier than that, the Nifty 50, which is the origin of the, I guess, of the Indian headline index. The Nifty 50 was, of course, in the 1960s, and what we see here from this chart is that valuations for tech stocks at those peaks were much higher than they are right now. Today, we're talking about 25 times earnings for the larger mega cap stocks, whereas we're talking about nearly 40 to 55 times earnings in previous instances. So we're less concerned about overvaluation, especially given the higher degree of profitability. But where this all leads us, and this is one of our key longer-term strategic views, is that we think in the changing world that I've very, very quickly summarized, that we need to be looking at different ways of generating alpha, of generating excess return in an environment where the beta, the overall directional return, may not be as pronounced. And we've created this acronym called IDEA, which stands for Innovators, Disruptors, Adapters, and Enablers. I don't have time in this presentation to go into all the details, but these are various facets of the development of technology and the way that companies are likely to be benefiting from this. And what we note here in this chart is those groups of stocks I just quickly summarized have attractive combinations of expected sales growth along with reasonable valuation. So this would be one of the key longer-term themes that we would like to highlight to you. Now, turning to the more topical issues at hand, of course, we've had a spike in geopolitical risk. This is a longer-term global geopolitical risk index, which, of course, has increased quite significantly as a consequence of the Russian invasion of Ukraine. Now, what we find here is that risk appetite, which is on the dark blue line here, plummeted as we had a significant sell-off in markets. That's since recovered somewhat, but markets are still on a somewhat more tender footing, if you would, given the complexities of the geopolitical environment globally. Now, turning to Asia specifically, what we find is that in periods of geopolitical risk spikes, you tend to have difficult performance, obviously in the month when it's happening, but also in the next sort of 1 to 3 months. But on a 6 to 12-month view, the shock from that risk tends to fade, and you tend to get some recovery in markets, as you can see here from the right side of the chart. More broadly, when we have a 10% or greater correction in global equity markets, which we did have, when just immediately after the invasion of Ukraine, the global equity markets tipped down into a sort of a 10% correction. And what we find here, again, is that even when you have a broader sell-off in global markets, that on a 6 to 12-month view, you tend to recover from those sold-down positions, even as the darker blue bars here show, if you subsequently have a U.S. recession, which is obviously one of the issues that investors are currently concerned about. So really the point here is that there may be sort of tougher sailing in the next 1 or 2 quarters, but if one's patient, then the better fundamentals start to come through, especially from a sold down position, and you tend to get attractive returns, especially compared to what we think will be losses in fixed income. So this again underpins our constructive view on equities. Now let's zoom into some of the immediate issues at hand. And of course, higher oil prices and the broader increase in commodity prices is super topical. So we're having what we call a supply side driven oil price shock. And the reason why that's important is that if oil prices rise because growth is better, because demand is better, typically equities can do quite well. But if they rise because of supply side constraints, then you get sort of all the bad aspects of higher commodity costs without any of the offsetting benefits of better growth. And as you can see from this chart here, we think that oil prices will still stay high for the next 2 years, even net of the release of reserves by the United States from their petroleum reserve. We think that oil prices will be about $125 a barrel for the rest of this year and $115 a barrel for next. So we're in a period of high oil prices, and of course, from an Indian perspective, that's consequential given India's reliance on external oil imports. Now, the effect of a supply-side oil shock on commodity prices specifically, but also more broadly on growth, of course, has what you might call stagflationary consequences. Generally, it will lead to lower growth levels to varying magnitudes, as we show on this chart, and higher inflation. And a way to contextualize this is to see how our Goldman Sachs global projections of economic growth and inflation have shifted just in the course of the past month or two since this oil price shock and the invasion of Ukraine. The way to understand this chart is that the lighter blue diamonds are what we were expecting for growth and inflation at the beginning of this year, or just even sort of a month or two ago, and the darker blue diamonds are where we stand now. And pretty much everything is shifted up and to the left, which shows that you've got less favorable or more stagflationary combinations of lower growth and higher rates. So why is this important? It's because the market returns in Asia tend to be much worse when you have a stagflationary environment. What we see on the left side here is that your average quarterly return for the regional index is about 1% to 2%. So if you just didn't have any expectations at all, your sort of forecast for quarterly returns would be up, 1% to 2%. But when we have inflation above long-term trend, that tends to come down to about flat. And when you've got growth below long-term trend, you tend to have sort of down 1 or a bit more in terms of returns. But when you have the combination of higher inflation and lower growth, then you get on average about -6% on a quarterly basis. So this is why this environment of what we call quasi-stagflation, which is below trend growth and above trend inflation, is of significant concern to investors. And if you look at the right side of the chart, the reason for that is that you tend to have significant reductions in earnings growth during that time. Now, turning to another issue that markets are contending with, not only is growth under pressure and inflation rising, but interest rates are also rising. And I'm sure everyone knows that the Fed has turned much more hawkish. Expectations for the market and for our Goldman Sachs economists have significantly increased. This chart shows how we're likely to be engaged in a fairly significant tightening cycle by the Fed. And complementing that, at the longer end of the curve, we see a significant increase in U.S. 10-year yields. We've had more than a 60 basis point rise in just the last month in terms of U.S. 10-year yields, and we're expecting them to rise moderately further from here. Now, this is of consequence because in an environment where inflation rises, which of course would also engender higher interest rates, you tend to get significantly different performance by a whole raft of asset classes. So this is a bit of a complicated chart. I won't go into the details, but just the way to look at it is that the blue bars show how the assets perform when inflation is high and rising, and the orange bars show what happens when inflation is falling. And you can see there's quite a significant difference between how different assets, whether it's oil all the way on the left, or, for example, the U.S. dollar or U.S. 10-year yields on the right. There's a significant difference in terms of how all these different global asset classes perform depending upon the inflation environment. And what we see here is that there's also pressure in terms of how the market leadership is likely to change in the coming years. So this is an interesting chart which shows on the left side, to the left of this vertical bar that we've shown, how a variety of asset classes in the world have performed since the start of quantitative easing in 2009. And you can see all the way to the left that NASDAQ was up nearly 10 times, huge return, S&P up over 5 times, etc. So asset markets did very, very well. On the other hand, on the right side of this chart, this is real economy prices. So whether it's nominal GDP, wages, inflation, et cetera, and of course, their return has been very low. So really what the point of this chart is that during a period of quantitative easing, we've seen terrific performance and returns from assets. However, this chart from the 1970s shows that the leadership really changes in a higher inflationary environment. Gold has done well, commodities do well, but you don't have as good returns from other markets, and the real economy tends to do somewhat better. So this is an important shift in terms of the overall configuration of the global macro environment. And to really emphasize this point here, what we see here is that in an environment where growth is falling, as proxied by the ISM index in the United States, and either inflation is rising, which is the topic of the left part of this chart, or the Fed is tightening, which is the right side. If you look at this second to right series of bars, the average return for the S&P 500 tends to be most constrained during that environment. So this is why this kind of transition to a fat and flat range is a challenge. But the important point here to note is how do equities compare to bonds from an asset allocation perspective? And even with those challenges to the equity market, we find that the earnings yield compared to the yield you still have on bonds, which is still quite low, is still at a premium, a significant premium. So really what this suggests is, the acronym TINA, there is no alternative, that in a world where the overall expected returns are lower and it's a more challenging environment, equities still look to be one of the better places to be, and that also underpins our preference for equities compared to bonds. Now, within the equity complex, as this chart shows, this is the relative pricing of Europe, Japan, and Asia ex-Japan, and EM more broadly versus the US. And pretty much every one of these non-US asset complexes is at a discount to the S&P, and that reinforces the point I was making earlier, which is also reinforces our preference for parts of the world which are outside the United States. Now, just very quickly on the U.S., we think earnings will continue to rise at a moderate pace. We have a 4,700 target for the S&P. With the recovery that we've had in the U.S. index, we don't have terribly much upside to that. Even with the sell-off last night, we only have sort of 3-4% upside to the S&P. We've got more elsewhere. So this again underpins our preference for non-U.S. markets. Within the S&P, however, we would note that the potential return is going to be significantly different depending upon whether the U.S. tips into recession or not. There's lots of questions we're getting from clients now about the risk of U.S. recession, which we quantify at about 30-35% based on current circumstances. If we don't have a recession, then as the blue line shows, we can probably recover. If we do have a recession, then there's probably some more downside. So this is a key issue to watch going forward. Within the U.S., for reference, we like infotech, energy, and healthcare. We're less keen on various parts of the defensives as well as the autos and component space. Now, turning to Asia, and this is where I'm going to focus my conversation in the last third of my presentation. This is a little bit complicated chart, but it really encompasses three very interesting dynamics. The first is that on the bottom axis, we are calibrating the relative performance of the various markets and sectors in the region under stagflation conditions and also under rising interest rates. Because as I've been saying, these are the sort of the clear and present challenges to markets. And on the vertical axis, what we're doing here is evaluating how the degree to which markets have priced the changes in the macro environment. So anything that's the lower down you are on this chart, the better it is, because it means that markets have already priced in a lot of bad news. So as you can see from the red highlighted part in the lower right section of the chart, there's a variety of markets and sectors that they would include things like China, Taiwan, Singapore from a market perspective, and they would include things like the metals and mining sector, the banks, real estate, and some of the deeper cyclicals, which we think are the more attractive parts of the region to be in. I will note that over here, where if you can see my cursor, India is in a less favorable part of the market because it's actually done better than one would expect given the change in the macro variables, and it tends to be somewhat more vulnerable to stagflationary concerns. So this underpins, as I'll elaborate in just a moment, why we moderated our view on India a few months ago. We had been overweight all of last year, and as I'm sure everyone knows, India was the best performing market in the region. We moderated back down to market weight and feel that we love the longer term view on India, but feel that the market valuations are somewhat expensive. And that's why we think India is likely to be in somewhat of a trading range. And we think that for the next sort of two quarters, we'd prefer to have a market weight stance than an overweight stance. Now, just in terms of valuation, here this shows that valuations have compressed below what we think is fair value, even allowing for a bit more conservative share price target, given all the macro concerns I've been indicating. And if we pull all our views together here, what we can see is that we're expecting kind of low teens overall upside for the region. We're overweight places like China, Taiwan, and Singapore, as I mentioned. We're market weight on India, which I'll get to in just a moment. We have a kind of a variety of different parts of the region that we like, whether it's the tech, hardware, and semis, kind of on the growth side of things, or liking banks, and in particular, energy and metals and mining in the sort of the value and the commodity and interest rate sensitive space. We have a number of themes here, many of which we think are also relevant within the India market specifically, which would include beneficiaries of cost inflation, which would be companies with high and stable margins. We like the beneficiaries of higher rates, which would be the banks. We think you want to be careful about the risk of stagflation. So we've created baskets of stagflation winners and losers. And we think that in an environment where earnings growth comes under pressure, you want to be careful, you want to be focusing on that. And the lead indicator for this tends to be companies where the consensus is revising upward their projections of earnings. So we favor companies where the earnings are being revised up versus those where they're being revised down. Now, in my closing moments here, I just want to touch on our views on India. And I think I want to start here with the idea or the fact that we've had record foreign selling in India of about 20 billion US dollars really since late last year. And actually on a dollar basis, this is the greatest net foreign selling that we've had in the history of the market, slightly above the roughly 15-16 billion we had during the global financial crisis. As a percentage of the market capitalization, it's 0.6%, whereas in the GFC, it was 0.8. So depending which metric you look at, it's either the most significant or the second most significant foreign selling. But the point is we've seen a lot of outflow. But as I'm sure everyone is aware, that has been more than compensated by record net domestic buying, particularly if you look at the right side chart here, the flows into domestic mutual funds have been very, very significant, consistent, and high and stable. So the left side chart here, if you look at the blue line, the dark blue line versus the lighter blue line, it's really kind of a battle, a tug of war between the foreign sort of disinvestment in India versus the domestic enthusiasm for equities. And we think this is a very interesting kind of struggle that we want to monitor. The net of it, as you can see from the sort of the pink line here, is we've been in a bit of this, what you might again call this kind of fat and flat trading range. And I think this is really the result of this kind of battle of the titans, you might sort of say, between the foreigners and the domestics. Now, the reason principally why we've taken a somewhat more balanced or measured view on India really is just valuation. I mean, the punchline for our view is that we love the story, but we don't like the price as much. And you can see here on the left side that the forward 12-month PE for India, it peaked at about 24 times late last year. It's lowered a bit, but it's still close to 22 times, which in terms of, if you look back over 20-year history, is really at the upper end of the range. And on the right side chart, we look at the valuation of India relative to all the rest of the region. And here too, we are at record highs. We peaked at 65% recently, came off a little bit. It's re-expanded about 64% when we did this chart a few days ago. So we're just saying that India probably needs to kind of digest the handsome gains that it's enjoyed and let the underlying earnings catch up so the valuations will compress, and then we can have another good leg up. Now, just turning quickly to our macro forecasts, we have taken our numbers down a bit. We're still a bit above consensus, frankly, for this calendar year, but we are mindful of the current account balance, really because of the oil price increases that I was mentioning. And if we look at the impact of oil on India on the right side of this chart, we see India is one of the most potentially negatively impacted by a large oil price shock, which for argument's sake, we've calibrated here at $30 per barrel. So we just want to be mindful of these challenges that the market's facing. Now, turning to earnings growth on the left side over here, we're somewhat below consensus at about 19% EPS growth this year compared to 23 for consensus. We're in line with the 16% growth that's forecasted for next year. And if you look over at the right side, this is a waterfall chart that shows that banks, energy, and tech are really the key drivers of the expected growth that we're looking for. So really, I mean, the fundamentals are still great in terms of earnings growth. Overall for the region, we're looking at just 6% EPS growth overall. So India stands out. It's just the pricing that we're not as enthusiastic about. So to close here, we just want to show what our preferences are within the market. We like the banks, of course, energy, which is a beneficiary of the higher oil prices, industrials, and some of the domestic consumption and construction plays, cement and so forth. And we're less keen on the NBFCs, some of the staples, and other parts of the market that don't have as strong earnings growth. So with that, I think we're pretty much at time. I'd welcome our conversation. Let me stop my prepared comments there and hand it back.
Thank you for that lovely presentation. Fantastic to talk to you. I distinctly remember a conversation we had on the Voyage, different forum. It was in Mumbai, and we had the pleasure of hosting you to lovely Indian food.
And that's the downside of the virtual aspect. I don't get a good meal out of this.
Tim, now you made very interesting points about how should one go about approaching asset allocation in an inflationary environment. The attendees here are distributors, they're investors, and they are also advisors to clients. And the question which perhaps everybody wants to understand from your standpoint is that what is the best way to make your portfolio or your wealth Teflon coated, if I may use the word, against inflation?
I mean, it is a great question, and it's obviously a difficult one. I mean, I think there's, we live in such an uncertain and capricious world that I wouldn't want to say that you can sort of, bulletproof the portfolio. But what I think we can say is that in a world where inflation is rising, the relative attraction and performance of real assets that are more linked to the real economy, tend to do better than some purely financial ones. And so in practical terms, that would suggest and reinforces our view on being overweight commodities. We still think that the market's underpricing energy stocks, for example, and some of the metals and mining stocks. We think that gold has a place in the portfolio. Gold is a strong place in the Indian heart, so that will, I'm sure, resonate well. Real property and other sort of real assets should be favored. So if you can kind of diversify your portfolio along those asset class lines, and then within equities, favor the parts that I was quickly summarizing. And I know I spoke fast because I had to get a ton of stuff out. So forgive me if I went a little bit too fast to clip. But there are definitely parts of the market that look better. The other point which I'll make, and we just had a conference call with my other global colleagues just before our conversation now, that we were making, in one of the themes that we like within the market would be high dividend paying stocks. Because what we've noted is that if you go back to the 1970s, that stocks that pay high dividends, which give you kind of an immediate source of cash flow, were a very good place to be. So I think if you combine that margin resilience, the high dividend paying theme, the compounding growth theme, and then the real sort of asset theme, that would at least guide you in the direction of having a more insulated portfolio from the macro challenges and the headwinds that are buffeting markets now.
Tim, you understand the importance of risk and the starting point of valuations more than anyone else. So while the India story is a promising one, if the starting point is today, which is 8th of April, for next 3 years, do you think one should expect low returns, no returns, or high returns?
So, I mean, it's a great question. Thanks for asking it. And I'm gonna give you a kind of a two-pronged answer. And I'm not trying to be a two-handed economist here, but I think there really are two important points to bring out. So, number one is that if you look through financial history, and there's tons of textbooks and learned studies and all this, you know, one of the most significant determinants of future return is the price you pay at the start of your investing period. So it's not surprising if you pay a high price, it's harder to have a higher return over time. And if you start with a lower price, you generally have a much better, sorry, I had an alarm here. I just want to turn off. You generally had a much better potential for return. So just purely from that, it would say if your starting point for India is paying over 20 times earnings, then you shouldn't expect as strong returns as perhaps we've enjoyed over previous, call it, 5-year investing intervals. However, and this is a really strong caveat to that, India looks like it will be able to deliver quite strong earnings growth because of the very favorable underlying fundamental dynamics. And on top of that, and we've written a detailed paper on this late last year, we are very excited about the theme of what you might call the increasing digitalization of the Indian equity market. There are over 60 unicorns in the private sector that have been formed, and those will be coming into the market through listing. And as they come in, the configuration of the Indian index will start to shift, and will take on more of this kind of digital economy structural growth component. And that's something which, for example, in China was a terrific 10-year investment theme. A lot of wealth was created. We think of a similar dynamic that's taking place in India. And then just the last item I'd like to mention is that the outlook for a lot of other parts of the region, and here, there's a lot of concern about China, isn't looking quite as good as it was before. So I think that India, that high relative valuation we spoke about, I think it is high, but I don't think it's going to come down to perhaps where it has been, over the past 10 years. I think it stays high. So if you roll all this together, I think, yes, returns will be somewhat lower than we've enjoyed, but I still think they're going to be good in absolute terms, and India will be a good place to be investing. So the bottom line is that if investors can either see some sort of a price correction in India, which will give a better entry point, or we can wait for some time to let the earnings catch up and let the multiple just naturally compress, then I think that will be a very good time to re-engage in a more active manner in a positive Indian investment thesis.
So Tim, irrespective of the timeline we are talking about in the history, markets, they follow a cycle. It starts with skepticism, then there is participation, then there is euphoria, bubble, and a bust. At what stage do you think Indian markets currently are in?
Great question. We have a similar way of kind of characterizing the investment cycle. I'd say right now we're in what we call the growth phase. So we have a lexicon which is despair, which is the bear market, and then we call hope, which is when the market rallies before the fundamentals change, and that's when you get PE multiple expansion. And then you get the growth phase, which is typically when multiples compress, but the underlying earnings growth comes through, and then you get your sort of euphoria blow-off stage, and then the whole cycle tends to repeat. I think right now we're in a period where it's really the growth phase where valuations have expanded, and now it's going to be the earnings growth which catches up. We'll probably see some forward valuation compression, but as long as the growth comes through, I think we're going to be in that longer growth phase for India.
Tim, I distinctly recall a conversation on some other forum a couple of years ago, and this was once upon a time, literally, in life of a strategist. You made a call that you see a lot of domestic money coming into India. It was an outlier comment a couple of years ago, but look at the reality. It is now part of an Indian saver's life that you're investing into equities. Could that be the differentiating factor, Tim, which will keep Indian markets always at a premium, because demand now from the domestic folks is much higher than the supply coming from the global folks?
Well, it's a terrifically well-asked question, and thank you so much for remembering what we said. Yeah, it's good you remember the good things we said, not the bad things we said.
You say good things about India, so I like to remember them.
Yeah, okay. But in all seriousness, this is a very important point, and it's something which is, I think, particularly critical to all your distributors. who are the attendees at this conference, because I think this really is sort of the, their lifeblood, so to speak. And really the point here, the concept is the term we've dubbed, so to speak, is what we call the financialization of Indian household savings. So the concept is that Indian households save a lot. They've got a very strong and robust balance sheet, but the majority of it is in property, it's in cash, it's in gold, either around mother-in-law's neck or in the drawer, but not that much of it is in financial assets. And our view, based upon looking at how various other economies have developed over time, is that there's going to be a development of financial market investment, and there will be a structural shift and embracing of financial market investment by the Indian household. And so we think there's a long way to go in this, because if you look at the current deployment, we're still well below 10% of the household balance sheet being invested either directly in the equity market or through mutual funds or other similar intermediaries. So there's a very clear long-term structural trend of increasing share of financial assets in the household balance sheet, which itself is going to continue to grow as India's economic growth increases and people's wealth rises. So we think this is a really strong, fat, long-term trend, which is quite positive, and I think underpins, as you asked, kind of that sort of higher valuation for the Indian equity market. But if at the risk of becoming perhaps overly enthusiastic, I think the other kind of additional factor which we can look forward to, which could be a turbocharging factor on top of that domestic demand for equities, is the return of the foreign investor. I mean, for example, I'm in New York right now. I've just been going around seeing investors in Boston, New York, Connecticut, and so on. So I've just had 30 conversations with U.S. investors, and the general take in India is, yeah, we like it, but we had been overweight, looks a bit expensive, we pulled back, but we're looking to re-engage at some point. So I think that $20 billion of net foreign selling gives foreign investors the opportunity, if you would, to reload later on if they again become more enthusiastic. So I think that the combination of that secular structural deployment of Indian household balance sheet into the equity market could be complemented by a return of the foreign investor, and that could actually give us some pretty handsome returns for Indian equities at some point down the line. And I think that's an important thing to keep in people's minds.
Thank you for that. So Tim, I'd like to draw your attention to perhaps the most important financial headline last week, which is that the US bond yields have inverted. And historically, when that has happened, that has led to recession. How should Indian investors react to this headline? Because recession is bad news for everyone.
This is true. So there's a few points that are important that we need to unpack, because you said this is super top of mind. Just to deal with the recession question, first. I mean, of course, if the U.S. goes into recession, that's not good, for anyone. I think in relative terms, India will stand out as one of the more attractive places fundamentally, because India is still enjoying sort of the tailwind of recovery from the COVID-induced setback. And so, if trend growth is here, kind of COVID drove India's growth below that. We started to recover. We're still trying to getting back to where we could be growing at, and that's indeed why we think the economy could grow somewhat over 8% this year. So I mean, there's obviously good potential trend growth, but then on top of that, you get a bit of catch up, which we still have to enjoy. And so I think India and other parts of Asia indeed stand out in happy contrast to the risk in the U.S. of actually tipping back into recession, because you got just a completely different kind of monetary and fiscal policy cycle, as well as kind of growth dynamic, which underpins our preference for sort of parts of the world, including India, away from the U.S. But that being said, if the U.S. tips into recession, typically the equity market, would sell off to some degree. And we've noted that in the last 30 years, every time the U.S. has gone down 10% or more, Asia will follow. It may follow to a lesser degree, but it's going to be a depressing effect. So I think that is true, and it is something that domestic investors in India need to keep in mind. But there's a subtlety here. Forgive me if I'm getting a little bit sort of into the weeds on this, but the inversion that you spoke of is happening in what is colloquially called as the 2-10 spread, the difference between the 2-year yield and the 10-year yield. And the reason why I mention this is that we need to be careful about what signal we are extracting from that inversion of the yield curve. And the reason I mention this is that it's happened because the 10 years yield hasn't risen as much as the 2-year, which is why the curve is flattened and slightly inverted. The reason why 10 years aren't higher than you would think they should be from a fundamental perspective, given where inflation is in the US and so forth, is that from a global cross-sectional perspective, US yields look pretty darn attractive because German bunds are yielding currently 60 basis point, Japanese JGBs are yielding 25 basis points, and the Bank of Japan just came out and said they want to keep those there for what's called yield curve control. So my point here is that for the global pool of fixed income capital, which is quite large in the trillions of dollars, even if the US looks overvalued, relative to what you get elsewhere, it looks great. So what that's doing is it's suppressing kind of artificially for demand supply reasons, the 10-year. So what I'm getting with this is that the signal is kind of distorted by this technical kind of flow of funds issue and may not be giving us as clear an indication of actual economic recession risk as it typically does in other circumstances. So that's why that's the point I wanted to make. And again, as I said, we've got various models that sort of look at the circumstances economically, and the punchline is that we think there's about a 35% chance of recession, but it's not higher than that currently.
Tim, we just have 5 minutes left. I know you've got a long day ahead and it's been a busy morning for you. So my last but one question, Tim, is that if I look at financial history, there are decades when a region in the markets does well, whether it was Japan in 80s, followed by US markets, China, last 10 years dominated by US blue chip stocks. What are the chances that next couple of years could be a linear growth market? India could be a linear growth market like we saw in US in the last 10 years.
You say linear in terms of like that sort of India in particular could be kind of more on a secular uptrend compared to other markets? Is that your question?
So could get one bad year, but a couple of good years.
Yeah, I mean, I actually have a lot of sympathy for that view, and this gets back to the kind of the longer term comments I was making before about this change within the Indian stock market and economy, this greater embracing of the digital economy. And forgive me if I'm telling people here something that they already know and living and breathing, but we think there's actually a lot of positive potential in terms of what you might call the digital common good, which has been put out. And this, of course, is the India stack of the Aadhaar, biometric identification, the banking, the capability of doing digital banking, the KYC capabilities digitally, and then of course the universal payment interface, which allows for cashless transactions. The combination of this is the analogy here is with the construction of the U.S. highway system in the 1950s, which was something that had tremendous ripple effects. It was sort of a common social good that was put in place, but that connecting the U.S. by that highway system engendered a huge growth, productivity spurt, and a growth spurt. And I think the analogy here is you've got a digital highway which has been put in place, which is a common good, and is enabling the rapid formation of companies on top of that. And it's also including the vast majority of the Indian population, which previously was in the informal or the gray economy. And the potential here is that for however strong India's growth could be, that digital good and investment which has been made could actually boost up India's growth rate, even further. We don't know what that is. Could it be 1 percentage point or, more or less? But it certainly is a positive. And as that starts to be explored more significantly, that could lead to a structurally higher growth and better earnings and so forth. And that could give us a much better longer term Indian investment story. So, we're on board with that longer term picture. It's just right now at the current entry price, getting back to your previous question, we're a little bit less enthusiastic. So, really we're sort of buyers on a pullback. The longer term structural story should be positive. And that's how we kind of square the circle on that.
So Tim, last question, and something which in a sense I applied and I learned in the COVID times, tough times for all of us. Lenin once said that there are decades where nothing changes, and sometimes there are years when a decade changes. How would you like to apply that in context of investing? What has changed for long-term investors because of COVID?
I mean, obviously a lot. I think this gets into a larger conversation we have time for, but just very briefly, it shows, I mean, first of all, just how, sudden shocks can happen. So we'll need to be a bit humble in terms of what we think and what we expect can happen. And it suggests that, things like diversification, margin of safety and all that sort of stuff are really important, because you never know where the next shock comes from, including just most recently, topically, Russia's invasion of Ukraine, right? And the oil price shock we're having. So that'd be one point. The second thing that both COVID as well as this most recent geopolitical conflict shows is the threat to supply chains, and how the sort of the extension of the supply chain globally and the focus on reducing costs, that's now shifting somewhat to recognizing we need some margin of safety in the supply chain. It's probably going to shorten things. You've got sort of a different sort of geopolitical configuration, and it may result in a less efficient world, and one where you can have some duplication of supply chains and costs, and that's something we need to weave into the conversation. So I think that those would at least be a couple of takeaways that we need to be mindful of. And I think it goes back to your original question, which is a great way to sort of, I guess, close this conversation, which is, how do you weatherproof, bulletproof Teflon coat, your portfolio? I think that's a really well asked and important question, and an important one for everyone on this call to be considering actively as they advise their clients.
So Tim, we started with that, how we would love to host you to a lovely meal, Indian food, paneer tikka and naan, perhaps your favorite all time, and little bit of dal makhani and tadka dal. So we look forward to have you soon in India, and it was lovely to meet you again.
Well, thank you so much, and I'm going to take you up on a rain check on that meal for sure. So thank you so much for the opportunity.
Sumit, I'll hand it back to you.